Okay, how are you doing?
I haven't been this busy since 2008.
Oh, I bet. I bet.
Uh,
How's everything in London?
um, what's actually funny is all the people that everybody's gone back into their same roles. Saudis are blaming the rally in prices on speculators. Ed Morse says the supply constraints aren't real. And, it's kind of we're right back in the same place we were 20 years ago.
Seems that way, doesn't it?
Yep. Actually, this market feels like the same one of 02, 03.
Yeah. No, it has surprised me. It's had more legs than I thought it was going to have. I
Yeah.
listened to your podcast probably back the middle of December and listened to that, and I could see the fourth quarter, but I sure didn't see the rally we had coming now.
Yeah. No, this is well beyond what I ever thought was possible.
No, I definitely understand. We've got a few more people joining. I appreciate you taking the time to do this for me, Jeff.
Absolutely.
How long have you been with Goldman?
25 years as of this April.
Okay, I was thinking I met you in probably 97. So I met you
Yep.
23 or 24 years
Yep.
ago. And I've been trying to think
you were
of the
one of my
lady
very first clients.
yeah, I've been trying to think of the lady that you came down with that day, and I cannot come up with her name.
Was it
But
Edith Cooper?
I think that's right. I think that is right. But it's
You remember Colleen Foster, right?
right. I remember Colleen.
She just retired yesterday.
Did she really?
Yeah, I'm one of the last remaining souls left.
Yeah, you've been there a long time. There aren't many people left on the gas desk that used to be there.
I was actually Lloyd Blankfein and Gary Cohen's, the role was their idea. I was the very first Wall Street commodity analyst ever.
Were you really?
Yeah, they watched what was going on in the equity markets and then bond markets, and they go, we want to duplicate this, because before Jay Aaron was just punting Dubai cargoes in the Mediterranean.
Right.
And then they go, all right, let's create a customer business. And so, in fact, you were probably one of the very first ones that ever traded these derivative markets.
Okay.
Because the day I started in 96. And about the day I started is when the trader marks that's when all these markets really took off.
Right. Well, I know it was just the infancy back at that point in time, and there weren't a lot of people out playing heavily in the derivatives game or the commodities game and hedging, et cetera. Because at that point, everybody on Wall Street said if you hedged, people bought your stock because of commodity exposure. And that I'll never forget Bob Simpson telling people on a conference call one time that if you wanted commodity exposure, buy the commodity. If you wanted something with repeatable and sustainable earnings, buy our stock. And that's when I knew we had won, that the hedging concepts were going to take place.
Exactly.
So, well, I bet we have a few more people going, but I think I have it set up where you can share your screen.
Okay.
Again, for those of y'all just dialing in, a bunch of y'all might have met Jeff on and off through the years. I've known him a long time. It's always been fun to talk to him and get his perspectives on stuff. Last time I saw him was at the University of Chicago when he gave a presentation, and I was on a panel that day, and I'll never forget being on that panel saying, holy shit, if Jeff's the keynote, I don't deserve to be here. So I think y'all are going to enjoy this. Again, thank you, Jeff, and I'll turn it over to you and let you get started.
I think Ming sent you a copy of the presentation.
Yes, sir.
Actually, do you mind uploading it? Because I have no way to bridge the gap between my Goldman system and my personal system here.
We can do that.
All right. So what I wanted to do here is mix in a little bit of commodities 101, as well as what's going on in the current market. In fact, I would say this is probably one of the most exciting times I've seen in this current market setup. In my nearly 30-year career of doing this. So this is, commodities are, it's the gift that keeps on giving. So if any of you want to be thinking about, going into these markets, now is a good time. And, I think they're always just absolutely fascinating. But before I just want to, talk broadly about, the way you can think about a commodity. And you all know how to value an equity or a bond. It's a discounted sum of future earnings, dividends, or whatever it might be. It's your standard, discounted cash flow model. But when I go to ask people, how do you value a commodity? It is absolutely surprising how few people know, but they actually do know. It goes back to Economics 101, and it's just supply equals demand, which implies price equals marginal cost. So P equals MC is your way to think about how you value a commodity. And because of that, you think about, you value the equity as that discounted stream of future earnings. The equity is nothing other than an anticipatory asset. It prices expectations. Commodities are different in the sense that they price today's supply and demand. So the way you can say it, commodities are spot assets. Equities and bonds are anticipatory assets. They anticipate the future. That's important today because these really strong commodity markets that are telling you right now that the underlying environment is much stronger than what anybody thinks. So with that said, what I want to do is, give you a flavor of how we're thinking about the current, we call it I would argue we've entered a new super cycle. So I want to spend time talking about that. Then I'll finish talking about oil and gas more specifically. And so I want to start here on, let's go to page 2. I guess you're going to have to drive it, Jay.
Yeah, that's fine.
So what I want to do here is just talk about what the 3 drivers are of the structural bull market. And strangely, in the last 80 years, you've had 2 other big structural bull markets, one in the 70s and then one in the 2000s. Basically, you had one from 68 to 79, and then another one from 2002 to 2013. And when you look at this blueprint that I'm laying out for this one, the other 2 fall in this perfectly. So we start with this whole idea of the revenge of the old economy. Actually, before I say that, I also want to say that we view the vaccine as being a tactical catalyst, but the pandemic itself represents a structural shift. And why do I say that? It's because the pandemic started out as a healthcare crisis, morphed into a economic crisis, and today it's a full-blown social crisis, exposing rifts between rich and poor, black and white. The level of social unrest today hasn't been as high as since the 1960s. The last time, actually the 60s are what really teed you up for that bull market in the 70s. So if we think that policy is now focused on social need, it means it's going to stimulate lower income groups. And you think about the policy after 08-09, it was focused on financial stability. And because it was focused on financial stability, it basically just created a wealth effect. And who owns equities and bonds in the world's wealth? The rich. So it was stimulus that went to the world's rich. It just simply don't consume. They saved it all. In contrast, and I'm going to show you some pictures about what happens when you stimulate lower income households, it's impressive at what they can consume. So with that said, let's jump into the 3 big themes. And I want to start with the first one, structural underinvestment. We call it the revenge of the old economy. And where we get that term was we coined it in 99-2000. When the dot-com boom was taking all of the world's capital, choking off the investment that would have otherwise gone into the old economy. And the old economy is oil and gas, metals and mining, autos, manufacturing, industrial processes. Exact same dynamics been going on since 2017 with the FANGs. And then when we think about the the recent time period, so the FANGs, Facebook, what is it, Alphabet, Netflix, Google, all of those, these are trillion-dollar companies that have been absorbing a lot of the world's capital. And then we throw on negative oil prices in the first half of last year, and then ESG issues. There is no capital going to this sector. By the way, this whole idea of new economy taking away from the old economy, you had the same story in the 60s. You had the Nifty 50 that took all the capital away from your old economy then. In the 90s, you had the dot-com boom. In the 2000 teens, you had the FANG boom. All of these absorb too much of the world's capital. And by the way, the returns are great. What it's telling you is the returns in things like oil and gas and metals have got to get up to par with these new economy companies. And the only way that happens is through higher commodity prices. The second theme is revving demand through social need. This is just policy demand. And when we think about what's ultimately driving this, it is the social unrest created by income inequality. And by the way, every policymaker in the US, Europe, and China has told you income inequality is the #1 issue on the policy agenda. I'm going to show you some pictures later on. The income inequality and wealth inequality is as bad as it was back in 1896 when William Jennings Bryan, gave his Cross of Gold speech. So, it's pretty bad right now. And there's 3 themes here, and these were part of the 70s as well. You have redistributional policies. In the 70s, it was the welfare transfer payments. And by the way, once you let that genie out of the bottle, it's really hard to put back in. We'll see what happens with this vote on that 1.9 trillion. My bet is you're going to even have Republican senators voting for it. It's just too risky not to do it. You saw what happened to Mitch McConnell with Georgia. They didn't give the $2,000 checks and they were out of a job. So once you've let these genies out of the bottle, and we let it out in 1967 with LBJ, with the war on poverty, it didn't get stuffed back in until Volcker and Reagan in 79-80. And we kept it in the genie in the bottle until last year. Environmental policies. This one is the war on climate change. And I like to call it green leveling, spending on green CapEx to level income. After this 1.9 trillion, next up is going to be $4 trillion worth of green CapEx. That is just another guise for dealing with income inequality. And by the way, you had a similar environment in the 70s. It was the war on acid rain, the sulfur. And interestingly, when you think about sulfur, sulfur cools the planet. Carbon heats the planet. And when we got rid of, you think about it, if you just have smog, which we hated in the 60s and 70s, the smog reflects the sunlight. That's what the sulfur did, which is why it was always cloudy and dark out. And by the way, getting rid of all that sulfur accentuated the carbon problem, the heating. In fact, there was this event called IMO 2020 recently that got rid of all of the marine sulfur. MIT estimates that policy alone raised the Earth's temperature by 1/4 degree. That's part of the reason. It wasn't just China that turbocharged it. It was the environmental policies of the 70s. The system was more stable with sulfur in it. Then the third one is the versatility in supply chains. Again, like the 70s, you had a Cold War with the Soviets. Today, you have a Cold War with the Chinese. You got, Biden's talking about building out Made in America, checking out the supply chains of all of these important critical inputs. The Chinese are building strategic reserves of oil, grains, copper. When did the Americans and Europeans build their strategic reserves? 1970s. So you look at the environment today, it is really similar to the late 1960s. And then the third big theme is the reflation feedback loop. That's where you have a weaker dollar, puts upward pressure on commodity prices. Higher commodity prices lead to greater global liquidity. Greater global liquidity reinforces stronger demand and a weaker dollar, and it creates this feedback loop that circles around. I mean, that ultimately drove prices in the 2000s up to $147 a barrel. It was also at play in the 70s, and that feedback loop has started up again. So these are the three big themes of a super cycle. They were apparent in the 2000s, apparent in the 70s, and I'd argue they're apparent again today. By the way, it's not common view that we're in a super cycle. There's a lot of people who push back on that. So I want to make sure that this is a one-sided view you're getting right now. So what I want to do is just go over these three different structural stories, and then we'll turn and talk about the markets more specifically. But let's jump over to actually, let's go to page 3. Yeah, let's go to page 3. The picture on the left shows global oil demand growth going back to the 1980s. The dotted line that you see there is the average oil demand growth for the 30 years pre-2008. The dotted line in the post-2000 is the average growth rate over that time period. Striking how similar they are. People talk about the weak demand growth and demand cratering. The growth numbers are very similar post-08 as to what they were pre-08. What is different about the most recent 12, 13 years versus those other ones? The lack of volatility. There's no cyclicality to it. Why? Policymakers were focused on financial stability, market stability, everything you can possibly imagine to keep out any risk. They were terrified of risk after 08, 09. They de-risked the system. And when you de-risk the system, you throw out all the good things associated with it. Collapses in demand with low prices, clean up the low-hanging fruit in the system. Really strong demand and high prices benefit in fact, the part of the reason why you have such extreme wage inequality is you need those overheating environments where all boats rise with the rising tide. We never got that. And then COVID came along and people forgot about the financial crisis. It's behind us. But even OPEC, the picture there on the right, shows you it wasn't shale. They offset everything that the shale producers brought online. The net of this is the reason why you had financial stability is, I like to argue the global economy was caught in a mid-cycle trap. You couldn't get any good outcomes. The minute you did in 17 and 18, central bankers raised rates. And you never got any bad outcomes like in 15 and 16 because they cut rates. So we're moving into a very different environment. And so what I want to do is just quickly talk about, let's go over to page 5 and let's talk about one of these key 3 themes driving the structural bull market. The picture on the left shows changes in CapEx across the sectors of the global economy. Bottom line, no investment is going into the old economy. It's all going into tech. Why? The picture on the right shows new economy versus old economy, share prices. Bottom line, Netflix is a better business model than Exxon's. The reason why Exxon's no longer in the Dow anymore or the S&P. The reason why is because the business model simply can't keep up with the likes of Netflix. And so when we think about look at that picture, when we coined this term, the revenge of the old economy in 99, 2000, look at that gap between new economy and old economy, but look how it closes over the next decade. That's likely what's going to happen. So that's the supply story. Evidence of the supply story is every single one of these markets is in a deficit right now, with the exception of cocoa and zinc. Cocoa isn't because chocolate's sold in airports. The airports are closed. What it tells you, we just haven't been investing in the underlying supply. So that's the supply story. Now let's talk about demand, the structural rise in demand, because I think that that's absolutely central to this story. And so let's go to the next page. Let's see, 6. Let's go to 7. Let's start with redistributional policies and why they create demand growth. This picture shows the average propensity to consume in the US by income quintile. So the bottom quintile is the poorest, top quintile is the richest. And what you see is the rich consume about 87% of their income, they save 13. Now what that tells you is if you give them $1 of stimulus at the margin, what are they going to do with it? They're going to save it because they already have more than enough money. Now look at these lower income groups, the bottom, second, and middle quintiles. Look at, they all have a number above 1. What is that telling you? They're income constrained. You give them another $1, what are they going to do? They're going to spend 100 cents on it. Now you want to see the proof that this is not simply theory? Look at the picture on the right. This is a new Harvard database that shows consumption by zip code in the United States. So you can isolate low-income zip codes, middle-income zip codes, and high-income zip codes. And look at that. After those $600 checks, look at that jump in low-income consumption and middle-income consumption. It was up more than 20%. Now you're wondering why copper is at 9,500 a ton, oil's at $67 a barrel, soybeans are at $14 a bushel. That has a lot to do with it. And let's remember, the poor outnumber the rich. It's not a coincidence that the last time we did these policies in scale during the late 60s and 70s, you ended up with one of the most inflationary environments we've ever seen. And one thing I convinced myself, no demand, no inflation. You need to have the demand to get the inflation. So we made the argument that these redistributional policies lead to mechanical increases in demand. Let's see what it does to commodity demand. Let's go to the next page on 8. Here we have 10 deciles of income in the US on the horizontal axis. The vertical axis is how much of a dollar when these groups spend is spent on commodities. What you see is the lower income groups all spend on upwards of 50 cents per dollar on commodities, while the high income groups are 35 cents. And by the way, I'm going to be blunt here. I'm sorry if I don't sound PC, so I apologize up front if I'm offending anybody. But
they're with me, Jeff. So
pardon me?
They're with me, Jeff. So they've been offended.
Okay,
already.
good. I like to say, the rich guy in Chicago, he basically, he drives a Tesla, he has a well-insulated house, and he eats fish. The poor guy, the guy that was likely rioting the Capitol back in January, he drives a beater SUV, gets poor gas mileage, he has a poorly insulated house, and he eats beef. Why is beef important? Beef's pull on grains is 8 times that of fish. The bottom line, the poor guy just doesn't consume, or the poor guy consumes a lot more commodities than does the rich guy. Now, why was Trump so anti-climate change? It's because his base is that group in those, those bottom 5 percentiles. And that's basically rural America. That group is in the crosshairs for climate change and the war on carbon, decarbonization. Why? More of their income and more of their expenditures go to oil, go to gas, go to beef, livestock, all of these things that are just in the crosshairs of climate change. And I always struggle with, how are we going to pay for this? Well, we now know they're just going to pay, they're going to do $4 trillion and just issue a lot of debt to do it, because you were never going to get that group to pay for it. And by the way, Europe is no different than America. That's those same group that are in the crosshairs. They're Le Pen supporters in France. They're everywhere. And I look and I talk to these groups. I go, I was at this event recently with a bunch of environmentalists, and they were like, I was saying it's going to cost $4,000 per person per year till 2050 in the United States to achieve become carbon neutral. They looked at me, $4,000, that's not much. I go, for a family of four, that's $20,000 a year. The average income in the United States is about $54,000. It is too expensive to do unless you issue a lot of debt to do it. So this is, the impact on commodities. Let's go to the next page, on page 9. The dark blue line are the redistributional policies, the welfare transfer payments. The light blue line is the year-over-year changes in commodity prices. And as you can see, you around 67, you pulled that genie out of the bottle, and you can see it wasn't until 79 you shoved it back in. And by the way, you asked the populace in 1970, did they like inflation? They loved inflation. Why? House prices going up, wages going up, everybody feels good. In 1979, it wasn't that Paul Volcker was a magician. It was these people had enough of it. Interest rates were 15%, house prices were too expensive, you couldn't function. 80% of the people hated inflation by 1979. By the way, 70% of Americans want the $1.9 trillion package. A Democrat the other day said, he goes, I know this is wrong, but we need to get reelected. Everybody knows what this is going to do. The fact that commodities are already up as much as they are right now, and if you think about those $600 checks already did this. What's going to happen in 6 weeks? And I'll bet you we're going to get the 1.9. I'm sure you're going to see Republicans voting for it because they know they'll lose their job. Otherwise, that's going to turbocharge everything because it's going to be $1,400 more, and it's going to go into basic types of commodities. And then everybody tells me it's a one-off. It won't come back tomorrow. I like to point out, look at that. It kept going. Well, Nixon was a Republican. LBJ, a Democrat, started it. Nixon, a Republican, continued it. Carter, a Democrat, continued it. And then it wasn't until Reagan, a Republican, killed it off. So it's really, and by the way, it doesn't matter, Republicans or Democrats, the people choose what they want. And now the people have tasted it and they're going to want it. So I'm pretty comfortable in saying this is going to be around in some shape or form in a couple more years. So that's the redistributional policies. Let's talk about the environmental policies. Let's go to page 11. Dark blue line is CapEx share of global GDP. Light blue line is real metals prices. And so you can see we had a big CapEx cycle in the 2000s. That was the China boom. Then we had another big CapEx cycle in the 70s. That's like the war on poverty. We think you're going to get another one over the next decade. We think you're going to spend $16 trillion on CapEx, for green CapEx, that is. When we think about China in the 2000s spent 10 trillion. Put it in real terms, it's about the same. And when we think about China, I like to argue it was another redistributional story. You gutted the middle classes in America and Europe to be able to create a middle class in China. Why did this happen? You look at when China was admitted in the WTO. The date is September 17th, 2001. Does that ring a bell? What happened on September 11th, 2001? George Bush needed a vote in the UN Security Council to go use force in the Middle East. He traded China's entry into the WTO for a vote in the UN Security Council. And I never thought about the implications of what this would do. I mean, most of the problems we have today are a direct result of that. Because what did that do? Then that allowed China to trade freely on the global market. You untapped enormous amount of labor resources in the rural areas. And this thing went on from 2002 all the way till 2014. Once the returns were just negative, you could not outsource anything else anymore. But I think the key point here is these big bull markets in commodities are associated with redistributional policies. And I don't think there's an EM-DM story here. It was just bringing China up to par with Europe and the United States. Because why are we dealing with income inequality? It's that group that's been gutted in both America and Europe that are so upset right now. But I think in terms of looking at the environmental spin in the 70s, it was that war on climate change. And you had that war on poverty. And then in the 70s, you also had the Cold War. Now, don't dismiss what the Cold War in Vietnam did to those investment numbers. They were also a big chunk of that. But I think the key message here is we're likely to go through another big CapEx boom similar to what we saw in the 70s and the 2000s that were behind these big bull markets and commodities. Quickly on oil, you're probably all going saying, hey, aren't you telling us that all of this investment's going to kill oil demand? Yes, it will by 2030. Near term, it stimulates oil demand. We're going to actually emit a lot more trying to go produce all of this infrastructure to transition into a decarbonized world. By the way, I was hoping that we would have been in an environment in which we would get a functioning sulfur price like we did after the 70s, and we would have technology picked by the market. Not going to happen. COVID is now basically policymakers around the world, China, Europe, and the United States, need something to spend on. And the something to spend on is green CapEx. So now it's a public-private partnership. They're going to pick the technologies. They're going to go down this through hell or high water, whether you like the technologies or not. And maybe a lot of them are not the most efficient. Quickly, let's talk about how do we get the CapEx spend. Let's go to the next page. Here's our decarbonized. Basically, when you look at the world, there's roughly somewhere around 52 gigatons of carbon that's being emitted. By the way, the science on this I'm surprised anybody that really disputes the science on this is Venus is just full of carbon, and the carbon is a greenhouse gas. You emit it, the stuff goes up, and it gets trapped up there, and the heat comes back in. When we have the sulfur in there, at least, the heat would get trapped, but then it would hit the sulfur, and then it would cool off and come back out. Now we've taken the sulfur out, all you're left is with these greenhouse gases. And I think in terms of getting rid of them, this is not rocket science. You can count the carbon market just like you can oil or beans or something like that. We look at the supply and demand of this stuff. And, there's ways you can get rid of this, like having deeper roots on soybean plants and corn and stuff like that to get rid of it. So it doesn't mean you have to quit fossil fuels. Unfortunately, because you see that COVID's going to allow Biden to choose these technologies, we're probably going to go the no fossil fuel route. You asked me a year ago, I would have said carbon capture. But I think there's a high probability of what's going to happen here. And we learned this from COVID, is that it was way worse than anybody ever thought. And it hit you a lot faster and harder than anybody thought. I tend to think climate change is way worse than anybody thought, and it is hitting us way harder than anybody thought. And if that's the case, let's say it's 5 or 10 years from now, we're all holed up in our houses again, watching on CNBC as 5 engineering firms duke it out to figure out how to solve climate change quickly and really fast before we run into problems with our clients. And by the way, what did COVID also tell you? Don't underestimate the technological prowess of the human beings. We solved that thing really fast in impressive fashion. We can solve climate change. Now, let me ask you this. Let's say we have to do this on the fly. It's dangerous. And, there's insects. You got swarms going up through East Africa of locusts because of the changes in weather patterns. You got fires in Australia, California. It's 100 degrees in Siberia. the world is a very different place. You got freeze-offs in Oklahoma. If we're in a position we need to solve this fast, are you going to do it with EVs? The answer is no. You can't roll out EVs overnight. There's 1.3 billion cars on the road. There's only 5 million EVs right now, and Tesla only produced 500,000 cars last year. You're not solving this thing overnight. You're going to have to figure out how to remove the carbon out of the atmosphere, and it is doable. We know how to capture it. We don't know how to store it because it's a gas. I'm sure Jay can tell you storing gas is expensive, very difficult, and takes up a lot of density of the world's space. You have to create a solid out of it, which means you got to separate the carbon from the oxygen molecule, which is extremely difficult to do. We don't know how to do it. But by the way, we don't know how to store electricity either. So I like to say you got two options here. You figure out how to store the electricity, which we're struggling at, and we've had 100 years to figure out that, or you figure out how to store the carbon. Anyway, another way you can think about it, let's go to the next page on 13. Here's the cost and the carbon price per dollar per ton to abate everything out of the system, to get up to the full 52 gigatons of emissions, which includes everything from the livestock all the way down. You can see the low-hanging fruit. You can get about half of it pretty easy. It gets really expensive when you start to think about air travel and things like that. We don't know how to do it, which is why more likely than not, we need to figure out these carbon capture technologies. I will say Biden's doing it better than the Europeans. He is going to create incentives for them to try to figure out how to do the carbon capture. This is the environmental part. Let's talk about the versatility in supply chains, the V of the REV. So let's go to 15. I mean, there's a Cold War with China, whether you want to call it that or not. In fact, you know what I think it's become? It's really centered around decarbonization. You'll notice that once Georgia went Democrat, Xi Jinping got all green on us overnight. Chinese are more green than anybody else. Why? Because they knew there was a high probability with Georgia as Democrat, Biden would team up with the Europeans and hit them with a carbon border tax. So if you see that coming, you got to one-up the Americans and get more green than them. And so now, instead of an arms race, we have a decarbonization race, because the thing about being dirty, you can now use the whole global mechanism to cut yourself out of trade. By the way, China's the biggest benefactor of being green because they produce all this stuff. You're basically going to be trading Saudi Arabia for China in terms of a manufacturing center on this. So that's another reason why the Chinese are green. But now that the Chinese are green, now you're going to use the threat of a carbon border tax in a trade war as the bargaining chip here, which means I like to think instead of an arms race like we had with the Soviets, it's going to be a decarbonization race. In terms of looking at what China's doing right now, they're building strategic stockpiles of grains and then copper on the right, as well as oil. Copper is your new most strategically important commodity. Why? Is because if you're going to electrify the world, there's only one thing we know on the periodic table that can conduct electricity in a very pure form, and it's copper. And we're already out of it. We're at super cycle price levels, and we haven't even started this energy transition process yet. So we got a long ways to go on it. But what it tells you, Chile becomes the new Saudi Arabia, the DRC becomes the new Venezuela, and these metals producers, metals markets are probably going to overtake energy. I always said that metals were the poor stepchild to the energy markets. It's now going to be energy markets are going to be the poor stepchild to the metals markets. Metals, I think, are going to be an absolutely phenomenal place to be. And the other thing I like about metals is they can stand on their own 2 feet and be green and make money. Very few industries out there can say that. So that's the versatility and supply chain argument. Let's talk about the reflation feedback loop, and let's go to 17. Now, the reflation feedback loop is simply the petrodollar recycling story. Nixon took us off the gold standard in 1971. 1973, he goes to Saudi, and he says, you price oil in dollars, and in exchange, we will use our military to protect the kingdom, but we want you to take any surpluses and buy US treasuries with them. And that sealed the deal to this recycling reflation feedback loop. So the way it works is weak dollar drives up the cost of producing oil. Higher oil prices then in turn create more excess reserves in places like Saudi. Those excess reserves then create lending. By the way, the credit crisis in the 2000s was a direct result of that. The Chinese didn't know where to put the money. In fact, I like to tell a story about when I went to China in 2005 to pitch the Goldman Sachs Commodity Index to them. I met with the head of SAFE, State Agency Forex. And at the time, the surplus in China was so big, he was needing to spend $45 billion a month. It got to $100 billion a month. Try to place $100 billion a month. It's incredibly difficult. Why? Because there was nothing in China to invest in. They had no choice. And also you had this recycling system where they just put it right back into US treasuries that was developed with the Saudis back in the 70s. Now, though, you got to ask, do they have something to do with it? So in 2005, they put it into the credit markets. It was the cheap money that created the redlining, the subprime crisis, and all those problems in the 2000s. Because you recycled that money back into the system. In the 70s, it went to the Latin Americans and created the Latin American crisis in the 80s. So the point here is, let's start. Weaker dollar raises the cost of producing oil in places. Let's take Colombia. 85% of the cost of producing a barrel of oil in Colombia is local currency. So as the dollar weakens and the Colombian peso increases in value, then the dollar cost of producing oil also increases. Then let's go to the next page on there. Light blue line is the price of oil going back to 2005. The dark blue line is the dollar price of all traded goods that are traded out on, in dry bulk carriers and so forth. It looks just like the price of oil. Why? Think about this. Let's say I produce Barbie dolls in Korea, and I produce them in constant Korean won. And we know that the Korean won is correlated to the oil price through the oil dollar correlation, right? So if the price never moves in Korean won for Barbie dolls, and we know the Korean won is correlated to the oil price, then what does the dollar price of Barbie dolls have to look like? Just like the oil price. That's why China's excess reserves go up with Saudis, because oil in everything China exports looks just like oil. So higher oil prices makes the price of all traded goods go up, which then in turn creates more global liquidity. Now go to the next slide. What happens to this global liquidity? It gets let down. It creates credit. So it has a multiplier to it. And that's the feedback loop. Now let me ask you this. Let's say you're China, Saudi Arabia, somebody like that. Are you going to buy US treasuries this time around? Probably not. Why? Because you think that there's going to be inflation on the horizon, and you think that at this point right now, the Americans are just going to let it rip and just, let it go unwind. Odds are they are. That's what the market's trying to price today. So then you go, okay, what are the Chinese going to do with all this money? What are the Saudis going to do with all this money if they don't recycle it? The answer is they're going to spend it. In fact, Saudi's building this city out in the desert called Neom. The Chinese are building the One Belt, One Road. That's pretty inflationary in my book. And you already can see the evidence. You take the current account surplus in China, match it to the reserve sitting in the PBOC, and that's the central bank in China, they don't match. That means the money is not being recycled, it's being spent. So that's the macro story. What I want to do is quickly talk about inflation really quick. And let's jump over to page 21. The light blue line is income inequality, and the dark blue line is wealth inequality in the US going back over 100 years. This is the point I was saying. We're back to the levels of the railroad barons of the late 1800s. And you think about Bezos is probably as rich as those robber barons. In fact, I think Bezos is richer than those robber barons because Bezos, Amazon is a global business model. And this is what's creating all the anger. This is what Trump tapped into. It's apparent here in Europe. Everybody, that it goes back to you've gutted a good chunk of the middle class. In fact, I think somebody made this point to me. If you watch The Simpsons, and the middle class life that Homer Simpson lived in, that doesn't exist anymore. That show was made in '95, and that's really sits at the core of this and what drives the anger. And by the way, the anger, there's three groups: rural poor in America and Europe, and that's like the Le Pen supporters and a good chunk of the middle part of the US. You have the urban poor, that's like Black Lives Matter. And then you have the disenfranchised millennials that live at home. And now those are like the Reddit raiders. And by the way, these guys aren't burning flags on the step of the Capitol. The Reddit raiders are taking the GameStop and jamming it up, $23 billion. And they're breaking the glass of the Capitol. You have riots in the US. I mean, this is pretty serious. And if you don't deal with it, it's going to come back and bite you. And I like to argue, the China story was a pure economic arbitrage. Once Bush set that train in motion, you had high wages in the US, low wages in rural China. You just equalized them. That was all that was going to happen. Here, I would argue the arbitrage is different. You don't have it. The arbitrage, if policymakers don't respond to this and deal with it, it's going to come back and bite them in the ass. And you already have seen it. They didn't put the $2,000 checks in Georgia, and then the Republicans and Mitch McConnell were out of a job. And that's why I tend to think Republicans are going to vote for this thing, in the next day or so. So let's go. If we have to solve income inequality, let's talk about how we do it. Let's go to the next page.
Did it not switch, Jeff?
Oh, I'm back. I think we got. Oh, is it not connected?
Let me stop sharing and reshare.
All right. Yeah, the next two slides are the most important.
That work?
No, I'm not seeing it. Let's see if it comes up. Oh, bummer. Let's try it again and see if it works.
Still nothing?
Oh, yeah, nothing. Okay. I'm going to describe how you do
Harris,
this.
Are you seeing it change, or is it staying still for you, Harris?
Yeah, it just says Jay Lauderdale started screen sharing, but nothing's happening. I guess it froze up on the last slide, and each time you try to start screen sharing again, it's just not working.
Okay, let me just shut it all down, reboot this PowerPoint, and see if that works. Sorry about that, folks.
Yeah, in the meantime, let me describe to you different ways to solve income inequality. By the way, you'll notice that greatest level of income equality in that last picture That bottom when the United States was the most equal was 1979. Peak inflation, peak real commodity prices. So what it tells you, inflation is the great equalizer. In fact, I had a client tell me the other day, never in the history of mankind have we ever solved income inequality without creating inflation. And what does the inflation do? It simply takes the rich down to the poor. It destroys all of their wealth. And so when you think about, everybody always says to me, well, I thought inflation's bad for the poor because things become too expensive. No, their wages are going up. It's a transfer of wealth from capital to labor. And let's say we do it the Mohammed bin Salman method, where we take all the rich guys, put them into the Ritz-Carlton, shake them down, take their money and give it to the poor guys. What is that going to do? It's going to create inflation. But that's not going to how it's going to work in the U.S. In the U.S., what is likely going to happen is it's going to be an overheating economy. Why? Going back to my point, all boats rise, everybody's wages rise, black-white wages compress in an overheating economy. Lower incomes accelerate past the rich in an overheating economy. Oh, here we go. Okay, what I've done is I've taken the global GDP and I've divided it up into 4 different quadrants. A recession, which is below capacity and declining, a recovery, which is below capacity and growing, and then an expansion, which is above capacity and growing, and a slowdown, which is above capacity and slowing. And what we have down here is the quintiles, again, the rich, the bottom, or the top quintile, the poor, the bottom quintile. And then we have changes in wages across each one of these quintiles. And, essentially what we see here is that when you're in the recovery phase, top quintile wages grow faster than bottom quintile wages. And when you're in the recession, again, the rich are outperforming everybody else. It's not until you get to the expansion phase, phase 3, where you're above capacity, that the poor really begin to overtake the rich. And so in the expansion and slowdown phases is when the poor do really well. So if you want to solve income inequality, and Jerome Powell tells you he wants to, Janet Yellen's told you wants to, Biden says it's number 1, Boris Johnson over here, he calls it green leveling, spending on green capex to level income. You have Christine Lagarde in the ECB has said it. Every policymaker in the world tells you they want to deal with this. They need to get an overheating economy to solve these problems because all boats rise. Now let's ask, what is the best performing asset class in the expansion phase when you're starting to narrow the wage gap? Let's go to page 23. The answer are commodities. And it goes back to this whole point I was saying, commodities are spot assets. Notice equities do really well in the recovery phase because the equities are buying that future great expansionary period. The commodities are the spot assets that do really well when it finally arrives. Which is why commodities are a great hedge against inflation. And by the way, the inflation simply comes from this group has money. This group outnumbers the rich. This group will spend on goods. That's what creates the inflation. Inflation is a byproduct of creating income equality. And so when we think about my example where MBS took the people to the Ritz-Carlton and shook them down, if you did that in the US with Bezos and the rest of them and then gave it to all of the poor, you would end up with the exact same outcome. You will get inflation because they'll just go out and spend it. And so when we think about, let's go to the next page on page 24, what's the best hedge against inflation? It's oil because of that correlation with the dollar and with commodities more broadly. It's not tips, it's not gold. It's oil. And, I can tell you right now, go to the next page on page 25, the amount of investment in oil is low. I mean, look at this picture on the left. It's, total oil net speculative positions is the orange. Look, it's not even up to the average. Picture on the right is total AUM, global AUM divided by oil positioning. Market's not long, which means the potential for more money. This rally you've seen is not driven by a bunch of speculative money ships sloshing around. It's been driven by, we're stimulating lower income groups who are going out and driving and spending. The backwardation on the forward curves is telling you that. So that's our, the outlook. I want to just spend a little bit of time. What have I got, Jay? What have I got? About 5 minutes left?
Yeah.
Why don't we do questions?
Okay, we can do that. Anybody who all has questions? Well, I know I have one, Jeff. You had mentioned that due to basically the government intervention in the markets, it has helped drive the inequality because you've not had the market adjusting to level things out. Can you expand on that a little bit?
Well, it had partially to do with the way the stimulus took place. This is what people will tell me. Well, they go, well, income inequality was a big issue in 2008. Why did they not deal with it then? The reason why is they had a financial crisis that was going to take the world down. And so policy, all that stimulus, everything was directed at creating financial stability. And so what did? They pumped all that stimulus into bank balance sheets to plug the holes for the non-performing loans, all of those subprimes and everything. And when they did that, and then they forced people like ourselves to hold all these capital requirements, that money just is parks in bonds. What did that do? It made interest rates go down. As interest rates go down, it mechanically makes the equity market go up. And so when we think about so you basically lowered interest rates by the Fed. The stimulus that they printed all went on bank balance sheets, which further lowered interest rates. And then you had the Fed buying back bonds out on the back end, which further lowered the interest rates, or buying bonds. So then you end up with a really flat interest rate curve. What does that do to equities? We estimate 66% of the rally in equities was directly attributable to low rates. So now we have this huge wealth effect. Let's ask, who owns the world's wealth? The rich do. Poor own savings accounts. So the poor were not getting a return on their savings account. The rich, who own all of the equities and bonds, were making out like bandits. That's why this wealth and income equality got so bad. Then you overlay on top of that what China was doing to the middle classes of Europe and America. The income inequality was being exacerbated at the exact same time that we were exacerbating the way the stimulus was being introduced. That's how this problem got so out of control. And by the way, they did everything to make it bad. Think about after what Dodd-Frank did. It went in there and prevented lending to lower income people because they didn't want redlining anymore. They did everything in their power to chop off any type of wealth creation for lower income people. The Democrats didn't want to admit that they did it because it was so, because the Democrats who did this, they're the ones who created most of this massive wealth redistribution. They didn't want to admit it. The Republicans didn't want to take it on because they were afraid that they would be viewed as supporting greedy bankers and reinforcing redlining again. So it was a dirty little secret that both of them swept underneath the carpets and never would tackle. Then COVID hit and everybody forgot about it. When COVID hit, then it allowed them to give them a license to spend. And now they're just doing direct subsidies to that group. By the way, it's going to end in tears, but it will go a long ways to solving the problem. And so that's why, how did it happen is because that stimulus, it created a wealth effect. The low income or high income people own the wealth. They're the ones who benefited from the stimulus. So all the stimulus 08, 09 to 2020 went straight into the pockets of the top quintile, ignoring the bottom quintile. In fact, and then the bottom quintile were choked off from credit. Savings accounts weren't paying anything. It was disastrous policy. But all the people who did it are all long gone.
Right.
But,
Yeah. Hey Jay, this is Aaron. If you're okay with me asking a question.
Sure.
Jeff, I sat on Jay's trade floor for I guess 7 years together in Fort Worth, and yeah, so I've had many things thrown at me, both insults and physical objects. So,
Good.
yeah, looking more into oil here, looking down the curve, you've got pretty steep backwardation, and you can from an investment standpoint, you can collect a positive carry and collect some of the roll yield there. Thinking about that in terms of other commodities, other consumption commodities, if we're looking at oil in the super cycle, in the, I guess, whatever time in the super cycle relative to other consumption commodities, is oil behind in that? And is there a corollary to other commodities that have a similar roll yield that can be achieved, and what type of roll yield are those other commodities achieving? Thinking maybe lumber there, or sugar, or other consumption commodities.
Lumber's in that category. I don't follow it, so I can't tell you anything about it, but I definitely know it's in that category. Copper is in that category, and soybeans is a turbocharged version of that. Because think about this, you killed off all the livestock. China's building strategic reserves of soybeans because it gets the feed to create pork. And so they have to rebuild the herds. Also, the Americans killed off their livestock as well. And remember my point about livestock, they just consume a lot of grains. I think of livestock as like an oil refinery. You put grains in, you get meat out on the other side. And the cows are the 8-to-1, pigs are 4-to-1, chickens are 2-to-1, and fish are 1.5-to-1. And so the overall demand pull on beans, also, the yields were terrible. I tend to think with climate change, a lot of the growing is going to have to move up into places like Canada and Siberia. And the hit on yields is pretty significant the last couple of years. We'll see if it gets hit again this year. So you have no supply, lots of demand. The annualized carry in oil on the first 2 months is 17% right now. That's a great return.
Yeah.
And when we think about, soybeans, 169%. So beans would be the one.
That's kind of the question. That's kind of the question is how much more room does oil have? Is there an equivalent? Yeah.
Let's focus on this slide right here that you're looking at on 25 on the right. Total oil spec positioning as a percent of global oil assets. We're on it. It's the one here at 25.
Right.
And so we take the total spec position in oil and divide it by global asset allocation and the total AUM and total wealth. That's everything in equities, bonds, everything. Remember, equities have been ripping to the upside. The overall position is just a fraction of where it could be. And here's the way I think about it. 2008, when we were at 147, you had about $1 trillion in these commodity markets. In today, it's about 300 billion. The bond markets are larger today than they've ever been because of QE. Bond yields are below 2%. If inflation just goes back to 2%, these guys got a problem. These guys are going to be your airline jet fuel hedgers this time around. And we're not, if they have $150 trillion in bond portfolios, let's say they just allocate 2% to commodities. That's 3 trillion. That's 3 times the size of what we saw in 08. So no, I think there's a potential for, a massive influx to come in here. I mean, you look at these markets, all of them, whether if it's copper, beans, oil, all of them are just marching lockstep upwards right now.
Yeah. Okay. Yeah. Thank you.
Anybody else have some questions? I know there were a couple of people that had planned on asking some.
Yeah, Jeff, this is Harris Napier here. Was wondering what your position is on how OPEC will affect the price of oil here in the future?
When we think about, again, the world's a very different place today than what it was 8 weeks ago with Georgia going Democrat. We now have a blueprint on energy transition in the U.S. And, as soon as they get their 1.9 trillion, they're going to put up the bat the 4 trillion for that blueprint. And by the way, the Americans are going to end up being far greener than the Europeans. The Europeans were the vanguard going back, going back, 6 months ago. Americans are going to pull in front, and now the Chinese are green, and so the Chinese are going to force it on it through trade war. So that means the clock is ticking on oil. Our estimates that oil demand growth slows down in 2025, and by 2031 starts to roll over. And so when we think about, and so it rolls over in 2021. Now let's ask, are you going to invest in any long cycle production ever again? The answer is no. There will never be any more investment in Nigeria, in Angola, Colombia, and that part of the world. These places like Nigeria and Angola can't even hit their quotas right now. Mexican production's in a free fall. There's only 3 places in the world you're going to invest in: U.S., Middle East, and Russia. Why? It's fast cycle. You go in and out in a very short period of time, and you don't expose yourself to that tail dropping off. In fact, when we think about the stack, the U.S. should be the 3rd to last producer. The Russians should be the 2nd to last producers, and the Saudis should be the very last producers. When I say Saudi, I mean Saudi, UAE, and Kuwait. So now let's talk OPEC. It's just that group, the Middle East guys. Their strategy is they want backwardation. So they'll manage those stocks to a low level. They've done a phenomenal job. The backwardation prevents those shale guys from hedging. And at this point, they know that supply curve is perfectly vertical. They just cut supplies by 11% and the market went up 40%. There's no supply response. And the question is, what price will there be a supply response? The cost of everything is rising really rapidly right now. We haven't invested at the margin in U.S. shale since 2018. We don't know where that number is. We know it's not at 67. Market's not really that interested in putting money to work here. I don't know where it is. I like to say, get long, hang on for the ride, and we're going to find it out. Now let's ask OPEC policy once they discover that. Once they know where that cost structure is, then we're going to understand what they're going to do. But it really is just Saudi. I tend to think that it's going to be a free-for-all for Saudi, UAE, Kuwait, Russia, and the United States chasing demand higher as production declines in all of that long cycle production. There won't be any OPEC policy. They'll just be going full bore out, producing as much as they can. Let me remind you, when tobacco went through the settlement, it did nothing but go up. And finally, the Philip Morris and the tobacco companies were worth a lot in the end. I think you should use the analogy of tobacco in terms of thinking about oil, because you just don't get the production.
Jeff, is there a price level for the independent U.S. producer to where they can generate enough cash to meaningfully grow their production?
We don't know that number right now. I mean, everything is going through a structural repricing right now.
Yeah.
And so I think that's why I'm saying get long, hang on for the ride, and we'll find out where that number is. I mean, think about dollars repricing, interest rates are repricing, steel is repricing, copper's repricing, everything is repricing. So we'll find out where that number is. I don't know. Could be 100, could be 120. By the way, the bond markets are unraveling. That's the biggest bubble. If that thing bursts and then floods into all these commodity markets, that number could be $200 for all we know. We don't know. My guess is it's probably 85 to 100. But again, we just don't know.
All right, thanks.
Guys, I probably should get going. I got to put my daughter down. It's a little late here. So if you have any other questions, email me. Jay knows how to get a hold of me.
Jeff, I appreciate your time this evening, and appreciate your insights as always.
You bet. I'd love to see some of you guys get involved in oil and commodities. So
Good luck, everyone.